Welcome to Novare Capital Markets Insight. I'm Todd Patton, partner with the firm and relationship manager. This is James Harlow, investment analyst on the investment committee. And to start off, James, I want to just ask you, the market is off to a pretty good start this year, probably better than most people expected. If you read all the headlines, it seems to be negative. But what are some of the things that are driving the markets right now?
Sure. As you can see on the chart on the screen, U.S. equity markets are off to a great start so far this year. One key element to keep kind of in mind, there are several factors that I'd say are kind of underpinning that rebound. But just as a kind of a starting point, investor sentiment was quite negative towards the end of last year. There was, especially in the final weeks of the year, there was kind of a lot of heavy selling. Some of that was due to portfolio managers trying to, generate tax losses for clients, tax loss harvesting by selling losing positions. So that was an element of it. But what that did is that had the effect of really resetting valuations in the U.S. equity markets, to more attractive levels. So I'd say that, just as a starting point, again, investor sentiment was low. Valuations heading into the year are more attractive. I'd say in terms of the, some of the main drivers for equity returns so far this year would be, inflation that's continued to moderate. Interest rates have gone down. Federal Reserve is towards the end of its rate hiking cycle. And we've seen economic growth come in more resilient than expected. And one element that we've talked about in the past with our prior videos is it's very rare for U.S. equity markets to decline 2 years in a row. So this rebound that we've seen in the market so far this year are commensurate with historical patterns.
Yeah. Okay, so you've outlined some of these main pillars. Let's dive into some of these a little deeper. Talk a little bit more about inflation, how that's affecting the economy and markets.
Sure. As you can see in the chart on the screen, inflation has continued to moderate. If you look back to June of 2022, the Consumer Price Index, or CPI, peaked at up over 9% year over year. That number coming into this year was 6.5%. And then the most recent reading in March was 5.0%. So again, we're not back to the 2% level that the Fed wants to see, but we are making progress. And some of that moderating inflation has come from energy prices have come down quite a bit from this time last year. We've also seen a normalization in supply chains and also just a normalization of consumer demand in general, which has brought down goods prices. On the services end of the spectrum, we still see elevated costs both from shelter and from labor. Really need to see those two elements moderate to really get that inflation back to that 2% level. It's important to note that the shelter piece tends to operate on a lag in terms of how it impacts the CPI, the Consumer Price Index. So in terms of we have seen the housing market cool down with higher mortgage rates, so we do feel like that's going to start to filter through those inflation numbers as we go through the year. And then despite we do have a quite strong labor market, but we are seeing some cooling down there as well, and that should moderate some of the gains with wages as well.
Yeah. So as we know, this week the Fed met and raised interest rates as expected. How are rates affecting the markets and the economy?
Sure. So you can see, last year, a lot of the market turbulence was, due to higher than expected interest rates. The Fed had to, really tackle it. Inflation came in, quite a bit higher than expected. That led the Fed to, have to raise rates at kind of the quickest level and highest level since 1980. That really just caused an increase in interest rates of all types, and it really did not give investors, consumers, corporations really a lot of time to adjust. And just as examples from just a consumer standpoint, rising mortgage rates, rising auto loans definitely have a significant impact. In terms of the Fed's policy, they have signaled that they that they are towards the end of their rate hike cycle. They have not gotten inflation down to the levels that they want to, but we've seen quite a bit of progress towards that end. And I think they do realize that there's a lag period between when they raise interest rates and when it impacts the economy. So, rate hikes that they institute today may not, flow through the economy for 3, 6, 12 months, depending on what area you're looking at. So I think they realize that it's prudent for them to kind of take a step back and see how their actions permeate through the economy. Current expectations are that the Fed has instituted its last rate hike for this cycle, and that as we get towards the end of this year, they may start to cut rates as inflation comes down more to their target, or if you see economic growth slow significantly. So that combination of the Fed signaling the end of its rate hike cycle, and then just economic growth moderating in general, we've seen key interest rates like the 10-year Treasury come down quite a bit this year. So just like last year, with higher interest rates, negatively impacting equities, we're seeing sort of the reverse of that this year with sort of a relief valve in certain parts of the market, especially some of the higher growth areas like technology, communications services, which were big laggards last year, have been some of the best performing areas so far this year. And just lastly, we've seen that historically at the end of rate hike cycles, if you look out the next 3, 6, 12, even 24 months, that U.S. equity returns tend to be quite strong, and you can see that in the chart on the screen.
Yeah. So you mentioned earlier in your comments that the economy has been more resilient than expected. Can you elaborate on why that is?
Sure. So if you look back to mid-October of last year, where the U.S. equity markets kind of hit their recent lows, I think there was an expectation that the U.S. was entering a recession imminently. And what ended up happening is that the fourth quarter GDP growth number came in better than expected. It came in quite solidly. And for the full year of 2022, U.S. GDP growth came in at 2.1%. Again, another solid number. And I think that you can see in the chart on the screen that expectations for 2023 are for anywhere from 1.5% to 2% GDP growth, and those are numbers that are more in line with kind of a typical year that you'd see historically, rather than a recession, which would be negative growth. We're still seeing just strong resilience, good underpinnings to growth. Strong consumer corporate balance sheets, still a really good labor market, unemployment rates at very low levels, job openings are at very high levels. Those are just not attributes that you would see in a recessionary environment. And so these have been, again, I'd say pillars towards, mitigating some of that negative impact from higher inflation, higher interest rates, and just is keeping growth better than expected. And I'd say just, lastly, we talked a lot about the U.S., but I think overseas we're seeing growth come in better than expected, especially Europe and China. With Europe specifically, towards the end of last year, there were a lot of concerns that Russia cutting off natural gas supplies to that area of the world was going to cause a recession. That ended up not happening. Winter weather was a lot more mild than expected, thankfully, so that they were able to avert those issues. And then with China, we're seeing upgrades to growth expectations as they relax their COVID policies. We're seeing better consumer spending there, and also just a unclogging of supply chains, which has also been positive as well.
Yeah, well, those are some great positives. We also know that there's always risk and negatives in the market. What are some of the things to be concerned about? What are some of the risk in the market right now?
Sure, I'd say one major one is just and I mentioned this before, the lagged impact of Fed rate hikes on the economy. Higher interest rates impact different parts of the economy in different ways and at different times. And so I think if you think about what do higher interest rates do? It raises the cost of borrowing for corporations. It raises the cost of borrowing for consumers. We mentioned, mortgage rates and auto loans. So we just have to see, how that kind of plays out as the year goes on. And I think that's why the Fed is prudent to take a pause here and see how their actions impact the economy. I would say that another risk to watch out for is just if inflation stays more stubborn than expected. I mentioned before that market expectations are for the Fed to go on hold and then cut rates later this year. And inflation stays stubbornly high, they're not going to be able to do that. They're going to have to either keep rates higher for longer or potentially return to rate hikes. And I just don't think that's a scenario that the market's prepared for. I think that would cause a sell-off of some magnitude. I do think we have to keep an eye on the debt ceiling debate that's going on in Congress. We've seen these situations before, and they do eventually always raise the debt ceiling, but they can get quite contentious, in certain circumstances. And we may see some volatility around that with news flow and different announcements that are made, especially as we head into the summer. And then lastly, I would say geopolitical concerns are always, something to keep an eye on. We've seen the impact that Russia-Ukraine conflict has had on commodity prices. I would say rising tensions between the U.S. and China, would be very impactful potentially to global economic growth, inflation, supply chains. There's a lot of technology, it's manufactured in that area of the world, so that would be, something to really keep an eye on.
Yeah, those are definitely some risks to keep in mind. So what would you leave us as any final thoughts on the market as we look forward to the rest of the year?
Sure, I'd say that, returns have been solid here the first 4 months or so of the year. I say, the S&P 500 price to earnings ratio is a little bit elevated now. It's a little bit over 18 times, which is, above kind of the historical average. And I think that's that higher PE is, predicated on the expectation that the Fed is done with its rate hikes. And that corporate earnings growth is going to rebound as we get into second half of this year and into next year. So those are elements that very well may come to pass longer term, but we won't get any confirmation on those elements anytime soon. So I think in the near term, I think that market's going to be focused on incoming economic data, inflation numbers, corporate earnings, and just Fed policy in general. So we may have a period here where market kind of digests the gains that we've seen so far this year. But I think for the year as a whole, I think an overall kind of general environment of the Fed being at the end of a rate hike cycle, that should reduce interest rate volatility. I think corporate earnings rebound would be positive, and the situation where the economy stays resilient, I think that's a recipe for positive returns this year.
Great. Wow, those are great thoughts. Thank you for sharing with us, and thank you for watching and listening.